Hey, it's Ryan from the Option Income Advisor, and today's trade analysis is focused on PayPal. I'm sure it's a stock and company that you know probably pretty well. It's one of the world's largest payment processors, digital payment processors. So if you've used the PayPal platform or Venmo platform, you've obviously used their services. It's a company that is growing very fast. It's pulled back quite a bit recently, so I think there's a really good opportunity here, not only from the stock purchase standpoint, but also on the option side. So we'll kind of walk you through, where I think the best opportunities are right now with the stock and the options. But we'll first kind of just go through what's happened over the last month. So the stock has pulled back. It's roughly off about 30% from its peak. A lot of these high growth, high multiple kind of stocks have been hit pretty hard during earnings. I think the bar was set extremely high for these stocks, almost priced to perfection. And so you've got this inflation / interest rate scare with a lot of these high multiple stocks. And so if you didn't hit your earnings, or even maybe even the whisper numbers, if you did beat earnings, or if you're guiding lower, there's something in the guidance that the street didn't like. I mean, these companies are getting absolutely destroyed after earnings. So this was definitely one of those cases. Obviously, it didn't go down as much as some stocks have, but this stock was. You can kind of look at it's a good segue into the chart. I always like to look at the chart kind of at first here. So you can see that this stock kind of almost did like a little bit of a double top here, and then sold off, right? So it hit a peak of roughly 310. This was back in kind of March earlier this year. This was kind of the original kind of interest rate scare among the tech stocks, and kind of pulled back. So you can kind of see it pulled back right around this kind of 230 range. And then, we took off, a lot of these stocks, bounced around a little bit, but definitely went back and tested these old highs. So, we went right up about 310 again. A little bit of a failed breakout, started trading lower. Again, this was another kind of interest rate kind of scare with these stocks. And then right here, this was about a month ago, PayPal announced that they were going to potentially buy. Actually, I don't even think they announced it, but it was speculation that they were going to buy Pinterest for a really, really high premium. And so market didn't like that, thought they were overpaying, didn't really see the true value and why PayPal would buy Pinterest. And so the stock sold off very hard, you can see right here, and then really didn't stop going down into earnings. And so this was kind of the earnings call here, and then kind of got pummeled again, over 10% on earnings. So, all combined, net the stock was down about 30%, over, call it a couple month period. And so we got a little bit of a bounce just a few days ago. Stock almost hit that 200 level, and I think this 200 level should be a pretty strong just psychological standpoint, especially because we did get a bounce already from there. So wouldn't be surprised if it tested it again. Also wouldn't be surprised if it just started bouncing higher and continued higher from here. I think this, if you just think about the prospects of this business, and these are the stocks that you want to buy in a pullback, ones that you can see the future and you want to be in these stocks, right? That's the whole point of certainly the triple income strategy, where we're selling puts and even buying stocks and earning income off of some of these movements. It's a volatile stock, but it's a stock that we believe in the future trajectory of, right? We believe that they're a leader in their industry. We believe that this stock will be higher 2, 3, 4, 5 years from now. And so there's no reason why, just kind of based on, we can go through the numbers here in a second, but why this stock can't, break out to all-time highs at some point in the near future. And so you're kind of looking at just where's my entry points, right? And like I said, I think this 200 entry point, just given how hard the sell-off has been, I mean, we've really had this stock, again, pretty much 2 days in the last month or so sold off over 10% in 2 different days, right? And so that's some pretty hard selling pressure for a stock like this, but we did get a nice bounce. Like I said, we bounced about $10 to $12 off its lows. And so we'll kind of see where it goes from there, but I do think that'll hold us support. So we'll kind of keep that in mind as we're thinking about this trade. And I think, on the very low end, you can see this support back here, right around the 180 level. I would be shocked if this stock broke down below 180. So I think you're kind of zone here if you're, looking to purchase or add shares. And again, I actually think this is a good buy at this price. But if you're really looking at, a true real safety zone, it's probably in this kind of 180 to 200 range. May not get there. And so that's why I want to talk about, what we call a triple play trade. So this is a trade that we can use on a stock that's pulled back. It's one we want to own, but maybe we don't want to load up on a full position. And so let me just walk you through my thought process on that. And so just to kind of recap what a triple play is. So triple play is where, again, you're familiar with the wheel, so I'm not going to go through the wheel, but essentially what we're doing is we're playing both sides of the wheel at the same time. And so it really means what we're doing is we're going to buy the stock, but we're not going to buy a full position, right? We're going to buy maybe a quarter to a half position of stock, right? So say upwards of, say, 50% of your position. And then we're going to sell a put with the remaining part of our position, so maybe the other 50%, just to keep it easy. And then on our stock that we purchased, we have the ability to sell a covered call if we want to. And on a stock like PayPal, we'll see that the premiums are still very attractive for the calls. And so you're not thinking long term here, and I think sometimes when people sell covered calls, they worry about losing the stock or losing the upside, and that can happen. Certainly, that's the downside of selling a covered call is you have to get rid of the stock, maybe at a price that isn't as high as where the stock ultimately trades. But you do have to look at time frame, right? So we're going to look at maybe a call, 30 days out. And again, it's just an option. It's not something you have to do, with a trade like this. I think the most important thing is, getting some upside exposure because we like this. We like where the stock's pulled back. It may not be the absolute bottom, but again, we want to add some capital, allocate some capital to this trade. And so we want to participate in the upside if it does, just move straight higher from here. So I think the important thing is to make sure we buy some stock and get some exposure there, but also get paid to, be patient to buy the last part of our position. And we'll walk through some of the prices and things like that. So, for example, if you wanted to own 200 shares of, if you're full kind of position size for, a stock of this share price. So, again, it's right around $200. Maybe you buy 100 shares of stock and then you sell one contract or one put at a lower price, which allows you to kind of average down at some point if it does trade lower, but you're getting paid, a premium to kind of take that risk. So I think that's a really nice balance, as we look at a stock like that. So let's go back to the profile, just and then we'll just get into the details of the trade itself. So you can see, the stock's right around 212, traded up 2% today. Obviously, I'm doing this after the close on the 15th here, but we're looking at a strike zone, and again, the strike zone is quantitative value that we calculate on all stocks based on their volatility profile. But I love it when the strike zone actually is, in essentially the same zone as, some of the support and resistance levels. So I like the fact that the strike zone's in kind of that 190 to 200 range, because I think that's like almost the perfect zone to write a put in. And so that's kind of where we're going to be targeting. But you can see even with the pullback, you can see this has a high safety rating. So, our safety ratings are based on, historical operating history, balance sheet strength, things like that. So this is a very strong, just stock fundamentally. And then from a valuation standpoint, even though this was kind of a high flying, high value stock, certainly carried a high multiple, it also is a high growth stock as well. And, we'll talk about some of the growth rates that the company has kind of laid out for us. But the valuation's kind of right around average, which for a stock like this, for a tech stock that has, some serious future growth prospects, I mean, an average valuation is almost a kind of a huge win in my book. And you see the pullback indicator is 10, which means it's pulled back quite a bit, and you can see it's pulled back 32% from its 52-week high. And so this is a stock that has definitely pulled back quite a bit, and that's why we're looking at it now. And then the relative strength is below 30. So from an overbought, oversold standpoint, it's certainly looking like it's probably oversold at this point with an RSI below 30. So these are all things I like about the stock itself as we think about owning it. Again, from a valuation standpoint, we're trading at 39 times forward EPS, which I think is not a huge multiple, or I would say too egregious of a multiple for a stock like this, because it is growing very fast, right? And it has historically carried a multiple even higher than that. So I think compared to where this thing is traded, I think its best days are still ahead of it. And you can kind of see, what I'm talking about with this annual sales and EPS. I mean, this is as pretty as the chart as it gets. And this is really what you want to see, out of a chart. And I'm willing to pay a higher multiple for a stock that looks, where a chart looks like this, right? And that's really what we got to get behind. And so this is 2021. Again, this would be fourth quarter. They just reported third quarter, and I think what they reiterated and maybe what spooked some investors out is, and a lot of these companies fall in the same boat. They're continuing to spend money on technology, and I think it's important, for them to keep their market share, to continue to grow. I mean, they have what's the number? 400 million active accounts on PayPal and Venmo. Venmo's got about 80 million accounts, and so it's really continuing to grow that technology, continuing to grow the total payment volume that goes through this platform. And I think just last year they produced or they had $310 billion of payment volume. So I mean, there's just a massive amount of payments that go through these platforms, and so it's really really about margins in the future. And I think what spooked folks out, and again, it's because when a stock's trading at a high multiple, you want to hear everything right? You don't want to hear that, hey, margins may be coming down a bit because we're having to spend more on technology or spending more in here. And so it was really price perfection again. I don't think it's anything that should spook long-term investors out by any means. So you take a look at that and say, well, the management team, right? We're right around $25 billion of revenue right now. As that's what's estimated for 2021. By 2025, they want to double that, right? So by 2025, they literally want to double revenue up to about $50 billion. And so they feel like they're on pace for that. Again, we're only 4 years out on that, but they want to double their revenue in the next 4 years, essentially. Which, I think you can't really find another business, certainly even one that's trading, at this reasonable of a rate. If I can find a company that's going to double their revenues in the next 4 years, and I can buy it at 39 times forward earnings, sign me up. So that's what I'm saying from a valuation perspective. This makes a lot of sense to purchase today. But from a volatility standpoint, I think you got to kind of especially looking at what the overall market is, where it's trading at versus, where I think, the scare could come in, as we enter the next kind of 3 to 6 months, right? It's really about, interest rates and inflation. And I think both of those are kind of headwinds for companies like this. But I think it's going to be short term in nature. I think it's going to be people overreacting. So the point is, it's going to be volatile, right? So we've established that, hey, we want to own this longer term. I think it makes a ton of sense. And just from an earnings standpoint, by the way, they're looking next year to be right around 540. So if we're going to go about 540 next year, and then by 2023, they're looking to be about 680, right? So that they're literally looking at this trajectory to continue. And again, that's a chart I want to see. That's a chart I want to invest in. I believe that this company has really, really strong future prospects here. And so, they want to grow their active accounts again by 2025 from 400 million today up to 750. And so, if they get to that level, and if they get to their 50 billion in revenue, I promise you the stock's going to be much higher than it is today. And so that's kind of the long-term view on the stock. And so again, I would consider the triple play, strategy with this stock, where we buy a portion today, and then let's look at the puts real fast, and then we sell a cash secured put at a lower price. And remember, we're kind of targeting that 190 to 200 level, and I'm looking at the December. So these are only 32 days out. This is the December monthlies. So these two look pretty attractive here. And remember, we look at, average monthly yield versus our margin of safety. And then we also look at the delta quite a bit. And so when I look at this, I say, okay, there's no earnings risk, right? We already got that out of the way. These are in the strike zone. Both of these are in the strike zone. I'm looking for a target for our base kind of level of about 1%. So if we can get 1% a month, that makes a ton of sense from a trade standpoint for us. And so we look at this one and say, the 195 gets us 1.1%, and it's an 18 delta. Or we could go even to the 200, and we get 1.6%. It's 25 delta. So both those are reasonable deltas. I'd love to see one below 20 if I can get it. If I can get my 1% and the delta below 20, reasonable margin of safety. I know that's below the psychological level of 200. So this is probably the one I would choose. If you are a little more aggressive, or maybe if you don't buy the stock today, I would certainly consider selling the 200. But since we're already taking upside exposure by buying some shares of the stock, this 195 will almost protect us a little bit more, make sure we get a better price on the way down. So that's kind of the analysis I would think about as you're looking at this triple play trade. And then if you wanted to generate some additional income, which, again, when you sell a covered call, it gives you a little bit of downside protection, not a ton, right? But it gives you a little bit of downside protection because it gives you a little bit of extra income. But again, you're obligated to sell it, at a higher price. But again, we're looking at this kind of 32-day, time frame with these December monthly options. And I would look up towards, the stock's trading at 212 today. I target, if I can 1% on the upside. It depends. If I've held the stock for a while and it's already run up, it's a whole different story. But one that I'm just getting in today, I'm going to kind of look at the upside and say, what would I be comfortable with or happy with over the next 32 days? And not try to get too greedy, right? Because that's where you get some poor premiums, I think, with these covered calls. When you're getting a little bit too greedy and want a higher price, you're not really getting paid much for it. And so that kind of balance I'm looking for. And again, we're with covered calls, we're looking at the average monthly yield versus the upside profit, right? So this is how much we're going to earn if the stock goes up and we get exercised on our call. Whoops, let me put that back there. Sorry about that. So I'm going to look at these kind of 230 to 250 range, and you can kind of just see the difference as we're analyzing these. right? This 240 gets us that 1% roughly, but it gives us about 14% of upside. So that includes this $2 premium we're going to get. So really, we're going to sell it for, 240 plus our $2 premium. So our kind of break even or max gain there is about 242. So if it goes from 212 to 242 in the next 32 days, that's a pretty nice return. And I'd take 14% over 30 days any day of the week. So that's really the analysis there, is if you wanted to go ahead and cap your upside a little bit just as a trade, and this is where the triple play comes in, right? You buy the stock, you've got some upside to make some capital gains, and very healthy ones at that. You're going to get premium from selling the call, so you're going to add an additional 1%, to your upside, or even as a little bit of protection, and then you sell a cash secured put, down below at say 195 or 200, to just average down a little bit on this kind of long-term position, right? So this is a way you can get into a, good solid cost basis on a stock that's pulled back, without putting all your eggs, in the basket right away. And so this is kind of a way we like to do it. Again, it's called the triple play. And you can see I love the upside of this business. I think it's been a great pullback. I think we're going to see a little bit more volatility. But again, I wouldn't be surprised if it doesn't go to 200. But I'd say let's have a little bit of protection there if we do. But let's grab some upside by buying some of that stock today. So that's our trade. Any questions? Let us know. Take care.